welcome you to this course on quantitative investments. We're going to be meeting for a few weeks, and during this time I will try to show you the different techniques that exist when it comes to investing, trading, quantitative finance, asset management, and a whole bunch of things of that nature. My name is Luis Seco. I'm a professor at the University of Toronto, and I also run an investment company. I will tell you a little bit more about that as we go along. Now, before I start, I always like to begin by asking if there are any questions before the course gets started. Is there any doubt, any curiosity, anything you would like to know before I start? Do you understand my English? Is everything good? Everything clear? Yes? Okay, good then. I'm going to start. You already know the tools you can use in Zoom. I usually cannot monitor the chat while I am lecturing, but I will do my best. If someone has something to say, I suggest you either interrupt me or raise your Zoom hand, and then I will attend to that. So I'm going to then start by sharing my presentation. I want to perhaps start by showing you, there we go, the website where it's a course website I put together for this purpose. I'm going to start sharing that. I understand some of you have been having difficulties with it. I would like to address those difficulties, make sure that we can use this website and that it's useful to you. Okay, so I'm going to be sharing that. Okay, so I think you have all been to my website. My website contains a teaching section, and within it you have the resources that I built for this course. If any one of you is still having problems with the logging into the website and accessing the material, I invite you to stay after class today, and I will try to solve every one of your problems. There have been some login problems, some authentication problems. I think they've all been solved, but I'm not sure. I think there is some browsing problems. I want to make sure that it's all fixed. In this website, you can see a number of different things. I have included some introduction to the course, and then I have 4 sets of lecture notes. These are the slides that I will be following in the course. Each of these slides will take approximately 2 to 3 sessions. They are the 4 basic themes I will be covering in the course, the 4 different chapters. I'm going to be dealing with a first chapter on investments. I will tell you what investments are, how they work, how they are set up, how they are sold, how they are bought. Then there's a next section which is some mathematical tools that you will need. Some will be simple, some will be sophisticated. I will be reviewing all of them. I will tell you which are the important ones that you have to know, and some others are reserved for those who have better mathematical skills and computational skills. I'll be discussing that for 2, maybe 3 weeks. Next, I will get into the topic of trading strategies. This is something where we're going to be seeing trading and investing very closely, and I will be spending maybe 2 weeks on that. By the end of it, you will be very skilled at building trading strategies. I'll explain to you what they are and how they work. And then finally, I will be spending time talking about investment products, because all of these things, they end up being put together into investment products that you can buy and you can sell. There are many more topics in the world of investing that I have not included here. There is issues of regulation, there is legal issues. I have not included that here. I think I don't have time. But if any one of you has any questions about anything, ask, and then I'll be happy to address it. In this website, I've also included some videos. They're all on YouTube, and I don't know how much access you have to YouTube. If someone can tell me, I will be glad to know. I know you can access through a VPN maybe, but I'm not even sure that's the case. Anyway, these videos are not critical. They are interesting, they are inspiring, and they address things which are not in the course. They help you go beyond. Besides that, I have included some papers, and I'll include some more papers if there is interest on different topics, things that go beyond what we are doing here in this course. Okay, so this little library could grow if you tell me what you're interested in. I have a lot of material. And then I have some books that may be of interest. You will see that there's a library link that I have included. This is a link to the library at the University of Toronto. You may not have access to that. In your case, I suspect you have access to your own library, and then you may be able to find the books there. These books are not required. They are just interesting books that may help you with the different topics that we have here. Okay. Now, everything in the course can be followed with these 3 sets of lecture notes. You don't need anything else. The lecture notes, you can see them directly on your screen if you click on them. There may be situations where your browser has some difficulties with that. I will look into that, and if that's an issue, I will make sure that you can at least download them to your computer directly. Once they open, you can download them by looking at this icon here. So this is how you download these notes to your computer. You are free to download and do whatever you want with them. Okay, you can download them all through that link. You can make them full screen. You can browse. I wanted to do it like this so that it's most useful to you. You can see them right on your screen. You don't have to go through a lot of steps to read the notes yourself. When the class ends, I will make a video of the class and I will share the video with you. I may put the video on my website. I may put the video on some shared drive somewhere. I will make sure you all have access to that. The video will take a few days before it's ready. They will be edited so that they are useful to you, and you can expect to have the video ready. We lecture on Fridays. By Monday it should always be ready, okay? And I will make sure that you have access to that somehow. They will be very likely on YouTube for sure as a default, but I may put them in a different platform, maybe on my own website for you to see. The advantage of platforms like YouTube is that they have a better access, and they give you more customized viewing if you access that through a computer, a phone. They are very smart at realizing how you are looking into the video, and they optimize the experience on that basis. Maybe I put them on Bilibili. I will see, and I'm happy to take your advice as to which is your preferred platform to watch videos, and then I'll put them there. It's up to you. You tell me. Okay. Any questions on this? On the resources, on the website? Okay. Then if there are no questions, I'm going to then move into the lecture itself. So I'm going to do a new share now. I'm going to go into the sharing of my main screen. Okay.
Please, Doctor, shares your video on our groups, WeChat groups.
On your WeChat. Okay. Yes, I can do that. But the video has to be hosted somewhere. The videos are very large. They are typically 5 gigabytes in size. So I have to host them somewhere, and I can share the link on the WeChat. But the videos themselves are very heavy, 5 gigabytes. You cannot send a video by WeChat. But I will put them somewhere and make sure you have access to them. Okay? Thank you. Okay, good. So my first chapter in this course is investments, the world of investments. I'm going to approach this from a historical perspective. I want you to understand what happened through history. What we have here, these are the things that you will learn in this course. You will be able to understand how history happened, how the world of investments have been changing over time, where we are now, and some of the advancements that are being done today. There's a particular period of history where a lot of the investment theory developed, and that is the period around the 1970s, in the last century. This was the period where the US and Iran had the oil embargo, which gave rise to the oil crisis. That was in the 70s. This was something very extreme for markets. You probably saw yesterday what happened to oil markets after the invasion of the Ukraine. Are you following that? Okay, so what happened in the 70s was much more extreme than that. So oil prices had a very large price movement, and back then the economies were very dependent on oil. So this had an effect. The price of oil had an effect in financial markets of all types. What you have here is the stock market in the US. This is the graph of the stock market in the US, and you see a period of very high volatility. Prices went up and then down very dramatically. This was around the time of the oil crisis. Okay, and from a certain perspective, this signified the beginning of a new era of investments, and much of what we're going to be talking in this course originated back then. You can make the connection with the headlines that's happening right now, okay, with the problems between Russia and the Ukraine. You can take that to the 70s, you can take that 50 years before, and you can see the effect of that disruption to world peace on financial markets. The fact that markets were so volatile, we will see what volatile means, okay? But right now we'll just use the name. Just use the name volatile. Markets were very volatile, and this volatility in financial markets created many of the modern techniques of investing that we're going to be seeing here. Okay. You may have heard about another event in 1929. That was the very famous market crash. That was the famous, that was the big crash. 1929. That big crash had a very big effect in financial markets too, but the effect here was legal. So the big crash had a legal impact on financial markets, whereas the 70s issues had a trading impact, and it's more related to what we're doing now. Okay, quantitative strategies developed in the 70s, not in the 30s after the big crash. The big crash, and I don't know how much of this you know. By the way, do you know what I'm talking about? Do you know about the 1929 crash? Can someone give me an indication if this is something that you know? This was a big crash in the United States, which was the big market at the time. Yes? No? Do you know about this? Have you heard this before? No one wants to say anything? Okay. I will assume that you know. If not, you can look it up. 1929. This crash happened because markets were not regulated. Okay, so what the authorities in the United States did was to regulate the markets, so what happened in 1929 would not happen again, and that had a good effect. In fact, that regulation is still in place today. That was the very famous 1933 Securities Act in the United States. So 4 years after the big crash, legislation was passed, and it made markets much more stable. What happened in the 70s was different. It was an almost war between United States and Iran, and the impact it had on oil prices. Oil prices can change the dynamics of stocks, bonds, interest rates, gold prices, everything, and that's what happened. Okay, so in our perspective in this course, we're going to be looking at the effects of what happened in the 70s to these days. Okay, and it's interesting that something similar is happening in the Ukraine right now. And I want to, just to give you an idea as to how important this is, here's a question that I have for you. Look at this situation. When markets are down, and here markets were down big time. This was a very big down movement that lasted like 10 years. Okay, do you need to lose money when markets are down? When the stock market are crashing or going down, does it mean that as an investor you're going to lose money? Can I ask that question? Maybe you can use the chat to answer now. Okay, you can answer yes or no. Give me an idea of what you're thinking. Can you use the chat and tell me yes or no?
请同学们用这个 Zoom 下面有 chat 的地方，然后进行作答。
So someone says no, 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 yes, no, yes. Okay. Thank you for answering. Yeah, the answer is no. The answer is no. Okay, the answer is no. And this is something that it was learned around this time in the 1950s, in the 1960s. Okay, the answer is no. And this created trading strategies. That was the beginning of the creation of trading strategies, and the objective was to ensure that even if markets are crashing, even if markets are going down, you can still make money. Okay, so let's keep that in our mind. At the end of this course, you will learn, amongst other things, how even when markets are going down, how you can still make money. That should be interesting, huh? Don't you think? Okay, so let's leave it at that. It's one of the things that you will learn during the course. But before we do that, I want to point out to the concept of making money. What does that mean? When you are investing, there is essentially two ways to invest. Two. One is when you invest your own money, and the other is when you invest someone else's money. There's a big difference between these two things. When you invest your own money, which is what most people understand by investing, then you have a certain approach. The approach is not very efficient. You have small amounts of money. We will see that some of the big trading strategies require big money. If you have only a small amount of money, there are limitations to what you can do. When you invest your own money, you'd have access to poor technology, and today having access to good technology is very important. And perhaps most importantly, you have very little information. You know very little about what's going on. It doesn't matter how much you read on the internet, you're going to have very little information. Okay? When you are investing someone else's money, things are very different. Okay? When you invest someone else's money, you have very large amounts of money that allow you to do better things. We're going to see examples of all of this. Okay, I'm just giving you the summary. We're going to see examples of all of this. You have very good technology and you have very good information. With good technology, good information, and a lot of money, you can make money more easily than if you don't. So there's a big divide and a very different approach to investing, whether it's your own money or someone else's money. We're also going to see the difference this makes for you. I don't know what your background is. I don't know what jobs you will have after graduation. But if you are rich, you will be maybe here, you will be investing your own money. And by rich, I mean very rich. We're going to see examples today, but this when you have $1 billion, okay, or say 10 billion RMB, is when you can think of investing your own money. Okay, that's a lot of money. Okay, that's 10 to the power 9 dollars. It's a lot of money. Okay. However, when you invest someone else's money, you do this through an institutionalized approach. And these are some of the companies that invest someone else's money. So, for example, insurance companies. You know insurance companies. Okay, there are many insurance companies in China, all over the world. In fact, some of the largest insurance companies in the world are Chinese. Fosun Group, Hanbang, many. So insurance companies, they invest someone else's money. Okay, this is money that's given to them by the premium. Legally speaking, technically speaking, is their own money, but it's the money that belongs to the institution. This is money which is there because at some point will have to be given to other people, either when they retire, when they submit accident claims, or when they die. Okay, so it's someone else's money from that perspective. That money will be asked of them, and they will have to give it. So the approach when it's someone else's money, you will see is very different. Okay. Another example is pension plans. There are pension plans in China. You may be too young to think of retirement. This is the money that pays you when you retire. Okay, but pension plans have a lot of money, which is technically not theirs. Technically, it's money that belongs to others, and they will have to give it to them when they retire. So again, the approach is very different. Another example of investing someone else's money is, for example, when you have mutual funds. Mutual funds are companies, and I'm sure you know many mutual funds in China. I don't know the Chinese name, but I'm sure you know. These are funds that you can invest your own money, small amounts of money, into a pooled fund. We're going to see how these funds work. These are examples. The thing is that you invest very little money, but because many people like you invest very little money, these are very big investment funds. And then they are big dollar funds, but they invest someone else's money. And again, the implication of that is that when you invest money in these funds, you can take the money out whenever you want. That means that this money is someone else's money. They will have to give it back when the other person wants the money back. This is going to have impact on how you invest. And there's others. I mentioned hedge funds. I want to use the word hedge fund a lot in this course because hedge funds are the most liberal funds that exist. They can do anything which is legal. Okay, we will see that many things which are legal cannot be done by mutual funds, by insurance companies, even by pension funds. But hedge funds can do almost anything which is legal, and we will see that also in this course. And then finally, I have another category which is prop desks. Prop desks is when banks invest their own money. Banks have money, they can invest their own money. Okay, so it looks as if it's your money, it's just that it's money that does not belong to a person, belongs to a bank. These are some of the players of big dollars when you are investing. And this, like I said, it's going to be very different if you invest your own money or someone else's money. I'm going to start this course with one example where you will see very clearly the difference between investing your own money, even if you're very rich, or someone else's money. But these are the two ways to invest. In this course, we're going to be spending more time with investing someone else's money. And the reason is, if you invest your own money, you have a disadvantage. And there's not very much you can do. also, I suspect many of you or several of you will end up working in companies that invest someone else's money. There's many jobs here, okay? Many jobs here, many. And here there are no jobs. Many jobs, no jobs. So I think you are going to be working directly or indirectly for companies that invest someone else's money. That's why in this course I like to focus on this. Okay, if you are rich and you have a small fortune and you want to invest on your own, you will also learn things which are useful in this course. You will see. But most of the things I will teach have to do when you invest someone else's money. Is this distinction clear? Yes. Okay, good. All right. So, if that is clear, I want to now talk another thing, another definition. This is almost a slide in English to explain some English terms to you. The difference between speculation and arbitrage. These are terms which may be new to you, I'm not sure, but I want you to know these terms. The first thing that we want to know is one fact, which is you cannot obtain returns, investment returns, without taking risks. You cannot. There's a mathematical equation that says this, but also practically, the act of investing implies risks. And the risk is the risk that you invest and you lose money, the risk that you invest and the money disappears, someone steals your money, or other things that we will see. Okay, so we will see that the exercise of investing is a balance between the risk you take and the return that you take. I assume you know what return means. Okay, if you invest $100 and you make $1, that $1 is a 1% return. We're going to look at returns in percentages and other units later, but that's what I mean by return. It's the money that you make when you invest. Now, talking about risks, we're going to see that the word risk is very important in this course. And the reason is that you cannot invest without taking risks. One of the things that it's very important to understand when you invest is what risks are you taking. If you don't know the risks, your investment is going to be bad for sure. For sure. So you're going to have to understand the risks. I want to help you understand what are the risks when you invest. And these risks are the same if you are a big investor or a small investor. It doesn't matter. The risks are the same. The categorization of the risks are the same. And I will show you. I will show you what they are. But risks can oftentimes be mitigated. Maybe not eliminated. Mitigated means you can make them smaller. And the act of taking risks and make them smaller is called hedging. We're going to see hedging strategies. These are strategies that make the risk shrink. Okay, I'll give you an example. I'm going to go back to my first slide. I want to show you an example of something that people did to mitigate the market risk. Okay, I'm going back, okay? I'm going to show you an example. Remember this graph? Remember this? I told you this was the consequence of the US-Iran oil crisis. There are risks here. What is the risk? The risk is that if the market goes up and you invest in a whole bunch of stocks, if you have a stock portfolio, when stocks go up, you make money, but when they go down, you lose money. Okay? And this goes back to my question, can you make money when the market is down? Well, some people realized around here around here, they realize that there's an exercise you can do, and this is what people did. This was actually something that started actually a little bit earlier. It started here in the 50s. What it is, they started to, it's a term which we will learn very much in this course. They started to short the market. We're going to see how you technically short the market, but shorting the market means you are going to sell futures. You're going to sell futures on the market. You know that? You know what that means, selling futures on the market? That means that if you sell futures in the market, I'll explain how this is done. But selling futures in the market means that if the market goes down in price because you sold it, you're going to make money. Okay? Of course, if the market goes up, you're going to lose money. So what people realize around here is that one way to decrease the risk profile of your stock portfolio is by selling some futures. Some, not a lot, some. How much? We will see. Okay? But if you sell some futures and the market goes down, your stocks will lose, but your futures will gain. The risk profile is shrunk. It becomes smaller. This is what we call by mitigating. This is what we call hedging. We're going to see this in great detail, but this started in the 50s, precisely during the oil crisis. This is something that people learned, okay? So that's an example of what I'm saying here, that you can mitigate risks by hedging. We're going to see a lot of hedging strategies, which is a way to mitigate risk. And I'll tell you one thing. We're going to start thinking like this very, very quickly. If your risk is smaller, even if you make the same amount of money, your investment is better. Okay? If you go from $100 to 101 and you take a lot of risk, that $1 is very expensive. You make $1, but it's a very expensive dollar. If you make $1 and the risk is very low, that dollar is very cheap. And we like that. We're going to see in various ways that understanding performance, understanding the money you make, has to be looked at from the perspective of the risk that you are taking. Okay? I want to ask another question. Please answer in the chat. Have you invested in stocks before? Stocks, not bonds, not other things. Stocks. Have you bought stocks? I want to know. Yes or no? Okay. Yes, no, yes, no. Okay, some people have. Okay, very good. Thank you. Thank you. Yeah. So, okay. So, very good. Thank you. So, if you have invested in stocks, how did you decide how much money you were going to invest in stocks? If you're very rich, you probably invested more money than if you're very poor. Okay? But what is the risk that you took when you invested in stocks? Maybe you invested in stocks that were very safe. They don't go up or down very much. Maybe you invested in stocks which are very cheap and you were hoping they would go up in price very much. Okay? All of those decisions are risk-based decisions. Again, risk is what was driving your decision to decide what to do. We're going to see a lot about that. We're going to see a lot of ways to quantify risk, and then when you make money, you will be able to understand from a risk perspective if that money was good or not so good. Okay? Now, sometimes you're going to have situations where you can invest with very little risk, almost no risk. Again, no risk, it doesn't exist, but very little risk. And this is called arbitrage. Okay, there are situations where arbitrage is illegal For example, if you know that a company is going to buy another company and this information is classified, then the investment laws of most countries will not allow you to invest in that situation in a public market. Okay, so I'm going to leave that as out. We're not going to discuss any illegal trading activities in this course. But sometimes you know that something, and we'll see examples of that. We're going to see examples where you can make money almost for sure, where the risk profile is very, very low. We're going to see many examples of this. And this is sometimes called arbitrage. Now, pure arbitrage means investing without risk. That doesn't exist. But when the risk profile is very, very small, sometimes the word arbitrage is used to denote that. So this is investing with lower than normal risks. Okay? And we will see a lot of examples of that. These are good, very good situations. Very good situations. When there is a possibility that you can invest with lower than normal risk profiles, these are very, very good. Okay? And typically these occur in situations where we say markets are inefficient. Now, this is a lot of words now. That's okay, don't worry. I'll give you an example where all of these things will become very clear. But I want to introduce the vocabulary first so that you can identify these situations when they come up. Okay? And there is one type of vehicle, investment vehicle, they're called hedge funds, and you will understand them also in this course, which are specialized in that. They specialized in looking at market inefficiencies, mitigating risks by hedging, and producing performance investment returns with lower than normal risks somehow. And I will show you how to do that. You will see that you will need typically a lot of money to do a lot of those strategies, but we will be reviewing those strategies nonetheless. Okay? Okay, so this is the interesting part. This is the interesting part of investing, if you can lower the risk. We're going to be putting more emphasis in lowering the risk than increasing the return, because it's easier. We will see that understanding risks is easier than understanding return. Return is hard to predict, but risk is easier to predict. And if you know what the risks are, sometimes it's easier to get rid of them. I'll give you an example. You're probably too young to own your own house. Okay? But if you own your own house, the first thing you do is you buy fire insurance. Why? Because if your house burns, you lose your home. If you have insurance, the insurance will give you money to maybe buy a new house or to rebuild your house, or it depends on your situation. So when you buy a house insurance, what do? First of all, you pay a premium. You pay a small amount of money. It's small enough you don't even think about it, you just pay. Okay? You hope that money you pay is wasted. You hope your house never burns down. So it is what we would call hedging. You are mitigating risk. You are paying something so that if your house burns, you have someone to help you out. Okay? So house insurance, fire insurance, car insurance, even life insurance, you're too young for that. But these are examples of hedging strategies that people do on their daily lives. The same thinking applies when you're investing. The difference is that when you are investing, the choices you have for hedging are very varied. There's many of them. We're going to see almost all of them. We're going to see many ways of hedging, but this is the concept. Okay? You're going to do something that may cost you money, but your risk profile is diminished, and then it's the better way to live. Okay? We're going to be doing some of that in this course. Okay. Now, going back to the question of investing someone else's money, someone else's money. Okay, you do that always through the creation of funds, which I will explain to you what they are. I'll explain to you what a fund is. In fact, we're going to be building a fund right here together, okay? And funds exist, and there are many different types. You already know some of them. I'll give you the full list right now, okay? Mutual funds, these are the most common in every country. You can go to most Chinese banks and you can choose, I'm sure they all offer mutual funds, and then you can invest your money in a mutual fund. A mutual fund is they take money of everybody, put them together, and then invest all of that as a group. And then you are the owner of a piece of that fund. If you invest a lot of money, you own a big piece of the fund. If you invest a little bit of money, you own a tiny piece of that fund. Okay? But you're part of a big pool. You're part of a big group of investors. That's a mutual fund. Another one is an ETF. This is an exchange traded fund. This is not exactly like a mutual fund. This is a fund that trades. It has a value, and we will see how they work. But you're not the owner of anything. These exchange traded funds, they typically do not invest in. And these are funds that are trying to mimic, they replicate what the market is doing. And when you invest in these, it's as if you invest in the market, but you do not invest in the market. They are not real from that perspective. But it allows investors to buy and sell securities that will mimic what the market does, and we'll see examples of this. Okay, they have grown very much over the last decades. In the last 10 years, they have grown a lot. Okay, ETFs, exchange traded funds. Then there's other funds, for example, infrastructure funds. When you're going to build an airport, when you're going to build a seaport, when you're going to build a road, a bridge, these things are expensive. Sometimes they are built by governments, but sometimes they are built by private companies. Okay, infrastructure funds, that's what they do. They fund the creation or the development of big infrastructures. Private equity. This is when you have funds who invest in private companies. If you create your own company and you need money, you go to a private equity fund, and maybe they invest in your company. Okay, that's what they do. They invest in companies which do not trade in the stock market. Real estate funds, they invest in buildings. They invest in buildings. Okay. Shopping centers, things like that, things which are like buildings. And then finally we have hedge funds. As we discussed, hedge funds, they do anything else, and they're unregulated in the sense that they can do anything which is legal, typically. Okay, but we'll see examples of all of these things. These are the types of funds that exist. Okay. I'm not going to spend a lot of time on the description of each of these funds, but I will just say a few things. You may have seen mutual funds. I suspect, I don't know how they're called in Chinese, but I'm sure that these mutual funds exist. I have been talking to a lot of banks in China, and I know they all have different types of mutual funds. Okay. And running a mutual fund is, as we will see, it's actually not very difficult. Okay, it's because when you're dealing with particular stock mutual funds, you invest in indices, you invest in groups of stocks, and when you invest in groups of stocks, all the investments really go together. We're going to see some analysis of how stocks move, and that's why in mutual funds they're very similar to each other. Okay, You can get daily valuation, daily liquidity. You can take your money into the fund and out of the fund every day, and they're very big funds. Okay, they're very big funds. Okay, mutual funds. Next is ETFs. I already described them to you. They are exchange-traded funds. They produce investment products that mimic investment in indices, which we will explain all of these things. Okay, if you don't understand, if you've never seen this, I will explain all of that. Okay? And they do that by following very simple methodologies. They also have daily valuations, and they have no volume constraints. They are very big funds. Exchange-traded funds. Infrastructure, private equity, real estate, we talked about them. They invest in private deals, like, for example, construction projects. And they have something very interesting. For example, they have one thing which is called no price transparency. When you invest in a mutual fund, you can check at the end of every day if you made money or lost money. If you invest in an infrastructure fund, you do not know at the end of every day if you made money or if you lost money. These funds, they typically invest for a very long period of time, and they have no way of doing accounting every day. Okay? Imagine that you invest in a fund that what they do is they build airports around the world. Okay? Airports in China, I suspect they are built by the government, but there are countries where the airports are built by individual companies. So your infrastructure fund could invest in airports. If you invest in the building of an airport that will take 5 years to complete, there's no way to know if you made money today or lost money today, because the operations don't have that level of detailed accounting. Okay, you think you're going to make money over 5 years. So if you invest, $1 million RMB in the fund, and then you wait 5 years, maybe after 5 years, your 1 million RMB becomes 2 million RMB. So you made 100% return after 5 years, but you don't know until you take the money out of the fund, until the airport is completed, if that investment made you any money. Okay, so there's no price transparency. You have to wait until the period is over, and only then you will know if you made money or didn't make money. Okay, and they also have another thing which is also interesting, called lockups. Lockup is sometimes when you invest in these funds, you cannot take the money out. If you invest in the fund that's going to build an airport, you have to leave your money there for 5 years. This is important because if people took their money out, then they can't finish the airport. And then the people who leave the money in, they will be hurt, because then the fund will have to close. The airport will not finish, and everybody will lose all of their money. So they have to lock up. Lock up means you invest now and you cannot take the money out. For a period of time. Sometimes it's a year, sometimes it's 5 years, depends. Okay? That's another way to invest. And they have limited capacity. Let's say that if you build an airport, the airport they need $1 billion. I'm going to use dollars very often, okay? Everybody does. So if, say, the airport costs $1 billion, then they can only take $1 billion of investment. If they have more, they're going to have to say no to some of that money because they don't need it, right? If $2 billion show up and they take it, $1 billion is not going to be used. So they will say no. They have limited capacity. And we will see what this means, okay? We will see what this means. There is an example that I'm going to be bringing to your attention that makes all of these things very clear. It's an example that I will explain with some luck today, and then we're going to be doing this example in great detail next week. Okay? Hedge funds, as I mentioned, are the types of funds that are unconstrained. They can do almost anything, And we're going to see examples of that too. So no need to go through this now. I'm going to go through this slide in great detail when we build our next fund, okay? And this is the example that I want to give you. I gave you this historical description, this vocabulary, I explained some terms. Now we're about to get started. But to get started, because I want you to understand everything that I say, I want to present one example to you. Today, I will have time to explain the example to you. Next week, what I will do is I will analyze that example in great detail. This is going to be the example that will explain many of the things we will learn in this course. We're going to create our own fund. Okay? In the next half an hour, we're going to become almost our own bank, all of us. And I want you to see how this is done. Okay? I'm going to call this the fund life cycle because we're going to see how a fund is born, how it grows, and how it dies. We're going to see all of that with one example. Okay? And the example begins with a conception, which is the idea. Most investments start with an idea, and this is the idea that I'm going to describe to you. Today, I will be spending time with the conception, with the idea. The next week, we will see how the fund is born, how it grows, and how it dies. All of those things, okay? Are you ready? All right, good. So, here's the idea, and it has to do with my country, Canada. And this is a fact. What I'm going to be telling you is true. All of this, well, the facts are all true. I'm going to tell you about a case that came up in 2003. Very interesting case, and this is the one that I'm going to use to create this investment opportunity, so you understand everything. Okay? It has to do with the city of Montreal. Okay, has any one of you been to Canada? Ever? No? Would you like to come to Canada? Yes? It's a little bit cold sometimes, okay? But it's a good country. Very good country. Okay, so it has to do with the city of Montreal. I am not in Montreal. I am in Toronto. Toronto is approximately 600 kilometers from Montreal. Okay, but the city of Montreal has a lot of snow. You see that? That's the city of Montreal. They have a lot of snow. In the winter, only in the winter. In the summer, it's very hot. Very hot. And the city of Montreal spends more than $100 million every year cleaning up snow. $100 million cleaning snow. It's a lot of money. Okay. What is interesting is how the snow is cleaned. The city does not clean the snow. The city hires companies to clean the snow for them. And the way they charge the city is they charge a flat rate. Every month, whether there is a lot of snow or no snow, they charge the same amount of money. Okay? But you have to decide if you want a certain month to be in your contract or not. The price is approximately, let's say is $20 million per month. $20 million per month. Okay, that's what they spend. It's a lot of money. And the company will tell you, will ask you, City of Montreal, do you want me to clean the snow in November? If you say yes, $20 million. If you say no, you save $20 million. But if there is snow in the month of November and you have to clean it, you have to call the company, it will be very expensive. Very expensive. In Toronto, in the year 2003, we had a snow in April. In April, we don't have a cleaning contract in Toronto. Okay, the city just waits, and in 24 hours, typically the temperature goes up, and then the snow just melts. But this year, 2003, the snow did not melt. After 3 days, the city was in chaos, and the city had to call the cleaning company and say, clean the snow. And the company said, yes, I'll clean the snow, but it's going to cost you $50 million. That's a lot of money for one event, but that's how these things go. So you have to decide, do you want to take the risk of saying no and saving $20 million, or you want to buy the insurance, you want to buy the protection and spend 20? You see, we're beginning to start thinking about risk and return. This is not an investment, it's a cost, but it's all going to be very similar. So should the city say yes or no to the month of April or the month of November, which is not clear if you're going to be using that. In month of January, February, it's snowing here today, okay? And the streets will have to be clear. The city of Toronto knows, and the city of Montreal knows that in February you want to have the contract. But there's 1 month in the fall and 1 month in the spring when you're not sure, okay? And it's an issue, and the cities don't know what to do about that. It's difficult. So turns out that someone had a very good idea. The idea was the following. The idea was to team up with a ski resort. The ski resort has the opposite problem. The ski resort, they want snow because when it snows, people go to ski. And skiing is a very big business in Canada. Big dollars. It's a big business in Canada. Okay? But sometimes in Canada, we have the month of December when there's typically the first snowfall, when there's no snow. It's terrible for the ski resorts because they have to invest a lot of money bringing people, hiring people, having the slopes ready, and then there's no snow. No one comes to ski. Big loss. Okay? And at the same time, if the snow season arrives early, or sometimes we have snow still in May, and the ski resorts are still open in May, fantastic. They make a lot of money. But then the cities are losing money. Right? So someone had an idea for the city of Montreal. It's a very good idea. The idea is to do what's called a swap. It's a financial term, a swap. You may have learned this financial instrument already. I'm going to pick an amount of money. I picked $10 million. Could be 1 million, it could be $1. It doesn't matter. Everything will be relative to the amount of money. But it's about 10 million. If there is no snow, the city is happy. They don't buy the contract. That was the idea. They don't buy the contract. If there's no snow, say, oof, I saved 20 million. I'm going to give 10 to the ski resort. The ski resort is unhappy because no one is going skiing, but they get $10 million from the city, which is good. And if there is snow, it's the other way around. The ski resort is happy and it's going to give some of their profit to the city, 10 million. The city will then take 10 million and can call the cleaning company and pay more money because they have $10 million to compensate. Okay? This is an exercise of, it's called risk transfer. They are transferring risk to each other. It's a type of hedging that we saw earlier. They are hedging their risks. What is the risk of the city? The risk of the city is snow in the spring or in early winter. That's their risk. This mitigates that risk. What is the risk of the ski resort? No snow. This mitigates that risk too. the advantage of the situation is that they can mitigate each other's risk, so they can exchange payments between them. Okay? Do you understand this? This is very simple to understand. So the ski resort and the city were negotiating a swap contract that would lower their risk profile. Okay, but now guess what happened? They did not agree. They liked the money, they liked everything. They did not agree on only one term. Everything was clear, everything was good. They didn't agree on one term. And that was on where to measure the snow precipitation. They didn't agree on one term, which is the where to measure the snow precipitation. The city wanted to measure it in the city, and the ski resort wanted to measure that at the ski resort. They didn't want to be measured anywhere else. And because of that, this deal died. It didn't take place. This is very interesting, and I want you to think with me what this means. I want you to think with me what this means. Do you think this is a pity? It is a pity because this was a very good hedging strategy. Hedging strategies, when they are good, people pay for them. Go back to the example of the fire insurance for your apartment. If your insurance is good, people will buy it. So good hedging is worth money. A hedging is like a very good product, okay? As good as rice or gold. It's a good product. And it's a pity that in this situation, the hedging strategy didn't happen because of a very tiny detail that I think we can solve on our own. I think we can have some ideas as to how we can approach this, okay? So I have a proposal. I want you to think about this and tell me what your thinking is. I will propose this to the city and the ski resort. Make sure that you understand what I'm about to propose. Now, this didn't happen, okay? This is now me thinking. And I want to share with you my thinking. This is going to give rise to a very interesting investment product that I want you to understand. I call it the business of risk transfer. This happens everywhere. It happens now to shipping companies. It happens to manufacturing companies. It's really everywhere. But in 2003, it took the form of a snow hedging strategy, which I want to discuss. So this is what we're going to do. I'm going to go to the city and I'll tell the city, I will do an agreement with you and you measure the snow precipitation in the city. No problem. I will go to the ski resort and I'll do the swap with you and you measure the snow precipitation at the ski resort. No problem. And I will take that risk. I create a fund, which I'm about to explain to you, and I take that risk. For the risk that I'm going to take, I'm going to charge 10% of the cash flows, which is $2 million. I'm going to charge $2 million, and I take the risk that I do these two swaps. Now, what is the risk that I take when I do this? I'm going to make $2 million, but what is the risk that I take? Who can tell me? What is the risk that I am taking? The risk of the city and the ski resort is discussed already. Their risk is lower. They are hedging this. No problem. I'm only increasing their cost. If they were paying 10, they're going to pay 11 now. Okay? So I'm increasing their cost by 10%. That's easy. Their hedge is taken care of. Their risks are mitigated. What is my risk? I told you I want to train you in thinking of investing from a risk perspective. What is my risk if I propose this deal? This is me. What is my risk? My risk is that it snows in the city and it does not snow in the mountain, in the ski resort. That's my risk. The city and the ski resort are very close. This is unlikely, but it could happen. Understand? If it snows in the city and not in the ski resort, I will have to pay 10 million to the city, and I will have to pay 10 million to the ski resort. This is unlikely, but it could happen. Normally, what will happen is the ski resort will give me money that I give to the city, or the city will give me money that I give to the ski resort. Normally, I'll have snow in both places at the same time or not. So I just take money from one, give it to the other, and collect 10% profit for me. Understand this? Understand this? I don't see. So one person says no. Okay. Can I ask you to ask me what you don't understand? Because I thought this is easy. I want everybody to understand this. It's just an example, but it's a very important example. It's very useful to understand. Okay? So again, this is a swap that is measured in the city. And this is a swap which is measured in the mountain. They're close. They're very close. They're about 100 kilometers. Very close. If it snows in one place, it's going to snow in the other. Okay? And we're talking about substantial snow, not just a little bit. Substantial snow. 30 centimeters, something like that. All of these things are written in the contract. Okay? We don't have to worry about that in this example today. If there is snow in one place, there will be snow in the other. Each of them wants to measure the precipitation in their location. It makes sense. So I show up and I take a geographical risk, which is that I'm going to take two swaps, one with the city, measuring the snow in the city, and one with the ski resort, measuring the snow in the ski resort. Same amount of money, 10 million in both cases, exactly the same. Normally, I take 10 million from one and give it to the other, and I collect 10% for me, 2 million, normally. But it could happen that there is snow in the city, so I have to pay them, and there is no snow in the mountains, so I have to pay them too. You can think that the opposite could also happen. It could be that there is no snow in the city, so they give me 10 million. And there is snow in the mountain, so they give me 10 million. And then I have 22 million. That could happen too. So I have a question for you. Is this a good investment for me? It's a good investment for the city and for the ski resort. In fact, for them, it's not an investment. It's a cost savings because they decrease their risk. So it's good for them. We're not going to think about the city and the mountain. We're going to think about me or us. Is this a good investment? How much money do I need to invest this? So that's my first question. How much money do I need? How much money? How much money do I need for this? I need 20 million. Yeah. Strictly speaking, maybe 18 million is enough because I'm going to make 2 million from that. Okay? So 20 million, maybe only 18. Maybe only 18 million. I'm going to say 20. Okay? So I need 20 million to do this deal. If I don't have $20 million, the city and the ski resort will not trust me. They will say, oh, you're just there to collect the money, but if you have to pay, you don't have the money, so they will not do the deal, very likely. Okay? So I need $20 million in the bank. Do you have $20 million in the bank? That's like 200 million RMB. Do you have that? Anybody is rich? No, you're not rich? Well, me neither, okay? But we're not going to worry about that. That we'll worry about next week, okay? What do we do when we're not rich? Today we think we have the money. Because we're on the conception, we're on the idea generation phase. We're going to think that we have the money. So is this a good way to invest the money? If I have 20 million, shall I do this? I make 2 million with very low risk. We're going to see the risk calculation in a minute. But with 20 million, we can make 10% return. We collect a $2 million fee. So here I have a question for all of you. You can answer in the chat, yes or no. Would you, if you have 20 million, will you do this deal? Would you invest in this, yes or no? It's a way to make $2 million with a very low risk profile. So write in the chat, yes or no. Yes, you would invest. No, you would not invest. Yes, yes, yes. Okay, so anybody says no? Anybody says no? No one says no. Oh, okay, interesting. Okay, very good. Very good. So let me, again, this is an example, but it's a good one because it's simple. I think you will understand what I'm about to do. I'm going to model this investment. And modeling always involves numbers. And that's why mathematics is going to be important, because when we're surrounded by a lot of numbers, we need to understand what's going on. And mathematics will be very useful in understanding what's going on. So I'm going to model this. I'm going to model this situation as follows, okay? And this is here only to, I'm opening up a door now. I'm opening up, you're going to see something which will take us a long time to understand. So I don't expect you to understand all of this now. I'm opening up a window and I want you to see the landscape. I want you to see something new. We're going to spend a lot of this course understanding all of this very, very well, okay? So bear with me. I hope you understand every term that I'm going to introduce now. I hope you understand. But if you do not understand, you don't worry too much because everything here will be explained. It is just that I want to take you very quickly to the end of the movie so you see how the movie ends. Hopefully I can create some interest. Okay? So this is what I'm going to do. I'm going to model this. I'm going to assume that there is a 50% correlation between the snow in the city and the ski resort. The word correlation, I assume, is not new to you. You have seen it before. Yes or no? Have you seen correlation? You have taken statistics? Yes or no? Can I see your thumbs? Yes. Okay. Some people. Good. All right. So let's assume that. We're going to do a lot of correlations and we're going to learn a lot about correlation. Correlation is going to be a very good friend of ours. It's going to be very important for us. But for now, let me just assume there's a 50% correlation between the snow here and the snow there. So if that's the case, and this is a number that you're going to trust me, and maybe I can explain to you how I got it, but some other time, not now, okay? That means that there's a 75% chance that that in my swap deal, I get money from one, I give it to the other. I already knew that most likely I just take money from one, give it to the other, and collect 10%. Okay, so 75% chance that that happens. 75% chance that I collect money from one, give it to the other, and I make $2 million. Clean. But there is a 12.5% chance that one of two things could happen. 12.5% chance that I get money from both, which is great, because then I make 22 million. Or a 12.5% chance that I have to pay to both, which is 20 minus my 2 million fee, which is 18 million. Okay? See that? So this is in numbers how my investment looks like with a 50% correlation. Okay, if the correlation is not 50 but is 60, 70, 80, the numbers will be different, will be actually in my favor. If the correlation is lower, the numbers will not be in my favor. Okay, but with 50, these are the numbers. So this investment looks like this from this perspective. Take a look. The invested amount is 20 million. That's what I need. The return that I will have is 10% because I expect to make 2 million. I can make more, I can make less. On average is 10%. I expect to make 2 million. But that 2 million is 10%. Okay, I'm going to write the 2 million as 10%. You will see why. And what is the volatility? What is the, let's say, uncertainty for now? What is the volatility of this investment? Well, you may not know, but I want to calculate it right here. And this is really the last thing I do today. The volatility is 50%. I will explain what that means. Okay? The volatility is 50%. What is the volatility? The volatility is the standard deviation of my cash flows, of the money I make or lose. Is the standard deviation of what's called a P and L. P and L. Profit and loss. Is the standard deviation of that. You may have seen the standard deviation. You told me that you know what the correlation is. I suspect you know what the variance is. So the variance of my cash flows is right here. The variance of my cash flows is right here. And I assume you have seen this. When I have three cash flows. One has a 75% chance, but then the deviation of my expectation is 0. Then I have another one which is 12.5% chance, and the deviation from my gains is 100% of my money, 20 million. And the other one is also 12.5%, and the deviation is again 100% of my money, 1. The answer is 12.5%, which means that my volatility, the standard deviation of the cash flows that I can make or lose, the standard deviation is 50% because the square root of 0.25 is about approximately 50%. Okay? Did you follow this calculation? It's the first calculation of the course. Did you follow it? If you did not follow it, you shouldn't worry too much. We're going to do this calculation many times in the course, but this is just the first. So can I get a thumbs up or down? Yes, you understand. No, you don't. No, you don't. Yes, you do. Okay. I will start with this next week, but right now I want to continue one more step so you see how useful this is, okay? This calculation is going to be so useful that we're going to be doing this. Stay with me. I have my return here, 10%. I have my volatility here, 50%. We're going to divide one by the other. Why? It'll take us maybe 1 month to understand this, but let me tell you, we're going to divide one by the other. When you divide, you obtain something that's called the Sharpe ratio. You may already know what this is. You may already have seen it. Doesn't matter to me right now. But when you divide 10 by 50, you get 0.2. And this is a number that tells us if the risk I'm taking is too high or too low for the return that I take. 0.2 is a low number. That means that this is not a good deal. Many of you, in fact all of you, said that you would invest your money in this. According to this number that I get here, we will not invest. It's not a good deal. It's a bad deal. Why? 10 million, making $2 million is great, but the risk is too high. That's what this number means. The risk is too high. Now, I just introduced this, and I'm just telling you this, and I calculated the standard deviation here, and some of you don't understand it, and then I divide it, and then I said this number is too low. All of these things are new. Okay? All of these things are new. I understand that. But I want you to see how in a situation like this, we can quickly determine if this is something which is good or bad. And we're determining that it's good or bad not because $2 million is good or bad. $2 million is great. Who doesn't like to make $2 million? Anybody does not want to make $2 million? Yes, you want to make $2 million, right? But the risk is too high. It just came up like that. The risk is too high. I did some calculations and I did some divisions, and I didn't tell you why I did it. I don't want you to worry about this right now. This will come. All of this will be explained. I'm going to spend many, many hours explaining all of these things. You're going to be very good at this. You're going to be able to tell the risk very quickly, okay? But we just saw something that hopefully you find at least interesting. It's useful, which is I look at certain parameters and then I know if the investment is good or bad. And then I know if investing $20 million in this, if I was rich, is good or bad. The answer is that it is bad. Or maybe not good enough. Maybe not good enough. Okay? So, this is very simple. The people that invest, they do many calculations, many more than this. This is very, very simple. You can all do this. Okay? You're going to be able to learn how to do all of this by next week, no problem. So I'm trying to highlight the fact that this is something that you can all do. This is very easy to do, and it helps you understand in complicated situations whether something is good or not in a very clear manner. Okay? So that's all I want to accomplish today. I'll tell you what I will do next week. Next week, we're going to understand this again. We're going to look at this. I'll make sure that everybody understands everything. And then we're going to have a fantastic idea. We're going to know how to hedge our own risk. Right now, we're hedging the risk of the city and the ski resort, and there's money there. They spent $2 million to be paid. $2 million if we hedge the risk. But we're going to learn next week how we hedge our own risk. So this risk that we have here becomes lower, and then it will be a good deal. And then we'll create a fantastic investment product. We will see this next week, okay? We're going to stop here. We climbed a bit of a mountain today, not a very steep mountain, but we climbed the mountain. Now we see the landscape, and we can see what we can accomplish with some calculations and a very disciplined, quantitative approach to investing. With this approach, we can accomplish a lot. But we have to understand everything that is on this page. So next week, I'll start with everything which is on this page, and we're going to go beyond, and we're going to build a beautiful investment product once we understand all of these numbers.